Hello, good evening, everyone. Thank you for spending your Wednesday evening with us. So please let me know po if clear po ba ako on your end. Kindly type C. And you naman po if unclear. I'll be checking the chat box for your feedback. Oh, nasa Q&A pala. There. So, thank you for that feedback, Miss Hazel. So, our webinar for tonight is timely with the recent na rate cuts, diba, in US and here in the Philippines. So, last August, 25 basis points yung reduction ng rate natin dito sa Pilipinas. Well, sa US naman, 50 basis points last September or last month. So, you would wonder, ano ba yung impact nito sa current na investment natin or sa current na mga asset na meron tayo sa portfolio natin. But before we delve on that, let me just introduce myself. I am Monneth Pangatungan, Visayas Business Development and Market Education Officer of FirstMetro Securities. It is the stock brokerage arm of the Metro Bank Group, and our company promotes financial literacy and creates awareness on investment opportunities to empower individuals like you and me and even institutions to attain their financial goal. And we envision to be the largest and most trusted Philippine investment solutions partner. It is my honor and pleasure to serve as your host this evening. So just like this event, we used to conduct our sessions on-site and face-to-face. However, due to pandemic, we shifted to a webinar format, but we are glad that we are continuously invited by public institutions, academic institutions, even private institutions. That's on top of our monthly webinars that we conduct here in First Metro Securities. So it's really amazing how technology add values wherever you are located. So saan po ba kayo ngayon nanonood ng webinar natin? Anyone here from Cebu or in Luzon or in Mindanao? Let me just check the chat box for your feedback. Andun sa Q&A. Andun na naman siya sa Q&A. Yan, from Cebu. Hi po. Anyone from Cebu? Mayong gabi sa inyong tanan. Oh, we have from Japan. And anyone here from Mindanao or in Manila? So good morning, good afternoon, good evening sa inyong lahat. So kahit saang sulok man ng mundo, pwede pa rin kayong makisali sa mga webinar series natin ngayon. And as of year to date, we have actually conducted 450 talks ranging from topics na personal finance to investment, even market outlook and market updates. So now, for us to understand the impact of rate cuts on UITFs, FirstMetroSecurities tagged expert along. So we invited a guest speaker from our fund partner, Manulife. So for your questions, kindly simply write them on the designated Q&A section of the platform, and we will try to get through as many as we can during the Q&A section. And for tonight, we are honored to have Paul Jeffrey Lu. He is the Chartered Financial Analyst and the head of Wealth Solutions of Manulife and Trust Corporation. He is responsible for the development of new products and collaboration across the organization to identify opportunities and enhancements that will strengthen distribution potential across different channels. He is also responsible for all offshore feeder funds, including the management of cash flows and speaking for those strategies in support of distribution. So let's all welcome Sir Paul on the virtual floor. Hi, Sir Paul. Good evening po.
Hello, good evening, everyone.
So you may now share your presentation.
Okay, let me just pull up our slides here. So actually, today's talk is about understanding the impact of rate cuts on your unit investment trust funds or UITFs. So rate cuts have been in the news recently. That's because, as Monneth mentioned, the US and the Philippines have both cut interest rates in the last quarter. This was actually the first rate cut from both central banks since 2020. So medyo matagal na since the last rate cut. It's been almost 4 years already. That's a really long time. Marami na nagbago dyan. In fact, over that time, our investment options has actually changed. So First Metro Securities has given Filipinos a much bigger selection of global investment options, and this includes yung mga UITFs ng Manulife. So this might actually be the first rate cut cycle where some Filipinos are holding on to global funds. So I think it's a good opportunity to really talk about the rate cuts in the context of global investments. So on the next slide, we'll begin our presentation by discussing the impact of the rate cuts on the global economy. So next slide, please. We want to give you some context, a quick review of why we are here today. And really to understand why we are here now, we have to quickly go back to the pandemic. We'll just keep it very short. So COVID lockdowns, they happened in 2020. Lahat tayo naaalala pa rin yun. The lockdowns, they disrupted supply chains around the world. So what does that mean? Yung mga manufacturing facilities, they were closed down. People couldn't get to work. Even yung mga ports where you can, export and import some of the goods that you need to produce goods, they were running on limited capacity. They weren't running 100%. But actually, even though there were lockdowns, wala namang demand because people were stuck in their homes. Na-feel lang natin yung impact na yan when economies started to reopen. So people were spending again. People were going to the malls. They wanted to experience being outside the house again. They wanted to travel again. But economies were actually reopening at different speeds. We all know that it's not just sabay-sabay lahat ng countries nag-reopen, but there were a lot of bumps along the way. So together with other disruptions like yung mga geopolitical risk, we saw global inflation shoot up to as high as 10% towards the end of 2022. Sa Philippines, it actually reached a high of 8.7%, which is a 14-year high. Sa US naman, it reached a high of 9.1%, which is a 40-year high. So inflation levels were really through the roof. And on the next slide, you can see that central banks, they started to raise their policy rates. So yung mga central banks like the BSP, the US Fed, they look to control inflation or yung pagtaas ng presyo ng mga goods by increasing interest rates. So higher interest rates make it more expensive for people and businesses to borrow money. It also makes people delay yung mga purchases nila because there are very attractive yields. Mataas yung mga rates sa time deposits, mataas yung rates sa bonds. They stop spending and just put their money in these high-yielding assets. So by slowing down the demand for goods, yung mga supply chains could start rebuilding and fully catch up to the demand of the reopening ng mga economies. So in the left chart, you can see that rate hikes started early 2022 and they ended by mid-2023. And the size was very large. Sa US, nagtaas sila ng interest rates from 0.25% to 5.5%. So isipin mo yung mga loans mo umakyat by about 5 percentage points. Malaking increase yon for normal people, for normal businesses. And sa Philippines, interest rates increased from 2% to 6.5%. So almost 5% din yung inakyat ng interest rates sa Philippines. In the right chart, you can see that it was effective in controlling inflation. So inflation went down throughout 2023 and 2024. Sa US, bumaba siya from 9.1% to 3%. Sa Philippines naman from 8.7% to 3.7%. And this is now very close to the targets of the central banks. So on the next slide, you can see yung 2024 story is actually about when will the central banks start to cut rates? It became a guessing game. Napupulaan na yung market. Kailan ba yung first rate cut? And as you can see in the chart that we're showing here, hindi siya madali. It was very hard to pin down when the first rate cut would happen. So the dots here show when the first rate cut was expected by the markets during specific points in time. So if you look at mid-2023, so the leftmost part of the chart, you can see that the first rate cut was expected in May 2024. But as we move towards end of 2023, the first rate cut gumalaw na. Nag-expect na yung market by March. So naging aggressive yung market. But then 6 months later, in middle of 2024, the market was now expecting the first rate cut to be delayed to November. So the market kept on trying to guess when the first rate cut would happen. And obviously, there was a lot of changes to the forecast, not just the timing of the rate cuts, but also the size of the rate cuts. But then in the next slide, you can see the market and the Fed finally settled in September. So September meeting, the Fed decides to cut rates by 50 basis points. So this is the first time that they cut in 4 years. The BSP actually did it a bit earlier. They did it in August and they cut by 25 basis points. So even though most people were already guided to expect a rate cut in September, actually may mga surprises pa din. And you could see it in our key takeaways in the next slide. So based on what we saw from the Fed meeting and what they were talking about during September, these are our key takeaways. Now, if the US economy cools further, the US Fed gave a very strong statement that they would provide more aggressive policy, which means they will support the economy if they see things getting worse, which the market obviously likes. Because that means that if we see bad growth numbers, you know that the US Fed will step in. Second bullet point, even the 50 basis points rate cut was stronger than what we expected. We were only expecting 25 basis points. So because of this initial strong response by the US Fed, we already moved our targets. Yung base case namin is now interest rates in the US to fall to 3% by end of 2025 and a total of 75 basis points rate cut before the year ends. So again, this is more aggressive compared to what we were expecting prior to September. Now, these lower rates are generally good for equity markets and also other asset classes as well. But really, the benefit is on the equity markets in our view. Now, other global central banks will also find it easier to start cutting rates when they see the Fed step into that direction, which we'll discuss also later on. Now, on the next slide, we want to connect all of this to how markets, financial markets, stock markets perform after the US Fed cuts rates. So again, what we are saying is typically maganda yung reaction ng investors. They like rate cuts because it helps the economy. But at the same time, hindi siya something that should trigger you as an investor to just buy anything and everything that you see. You have to look at what history is telling you. And based on the last 9 rate cut cycles that we see, global equities and US equities, they do fairly well naman 1 year after the first rate cut. So if you can look at the table, returns were positive 67% and 78% of the time for global and US equities. And the average return 1 year after the rate cut, 11 and 12%. So very good returns. But context is also important because if you divide the last 9 rate cutting cycles, there's a big difference in the performance if the rate cut is accompanied by a recession or if the rate cut actually helps to avoid a recession. And if there is a recession, yung global equities were only positive 40% of the time and yung 1-year returns mo flat na. US equities were positive only 60% of the time and yung returns mo were not so strong, 3% na lang. So it's very important to really look at where the economy is when these rate cuts are happening. That's why in the next section of the presentation, we want to take a closer look at how these rate cuts are happening in the context of the economy, because we think ultimately the opportunities for each fund will be different. Now, we have a lot of funds, but we'll try to group it into very broad categories for you: global equities, Asia equities, and our income and low volatility funds. So we'll start with global equities first on the next slide. Okay, next slide, please. Next slide. Yeah, so global equities. For global equities, we're talking about yung mga exposures sa mga developed markets. Those are more exposed sa US, sa Europe, etc. And global equities have been actually one of the best performing investments over the past 2 years. So yung left chart here shows the performance ng 2023, and the right chart shows the performance in 2024 as of September 30. So very fresh yung mga data namin dito. And just some key observations. First, you can see performance has been strong across all global equity funds. As I mentioned, it's been one of the hottest investments in the past 2 years. Most of our funds delivered double-digit returns across both periods, and it also paid to be diversified into these global funds because these are returns that you couldn't get from local markets during these 2 years. Second observation, global technology, American growth, which is our US equity fund, they were the clear leaders for the past 2 years. In 2023, yung return sila is 30 to 50%. 2024, it followed it up with returns close to 20%. They're always 1 and 2 for the past 2 years. And third, which not seen here in these tables, but there's been very little volatility. It's better shown if it's a line graph, but we don't have it with you. But there have been corrections, but they have been shallow. Medyo mababaw lang, and they have been short-lived, mabilis lang. And this actually made it easier for investors to hold on to these funds. Alam mo naman, pag equity is usually volatile. But if you're able to hold it because hindi siya ganun ka-volatile, because they've been performing so well, it makes it easier for yung mga investors to hold these investments and just really ride out the gains. Okay, next slide. So we'll talk a bit about why global equities are doing well, and they've really benefited from a Goldilocks scenario. So Goldilocks, ito yung fairy tale that we're all familiar with. My little girl named Goldilocks, she goes to an empty house. She sees 3 bowls of porridge. Tinikman niya isa-isa, diba? There's one that's too hot, there's one that's too cold, and then there's the perfect one. So the Goldilocks scenario is used to describe an environment where the economy is not too hot, not too cold, but just right. So yung left chart shows GDP growth expectations, and this shows that yung economy, yung global economy, has not cooled down. So the pink line is the forecast for world GDP growth in 2024. Very consistent siya at around 3% despite all of the tightening that's happening with central banks. And then the blue line is an even stronger chart. This is a chart of the 2024 US GDP growth. It's even stronger. You can see it started at around 2%. Now it's at 2.5%. People are even upgrading their forecast for US GDP this year. People have been pleasantly surprised with the strength of the US consumer spending. Now, the right chart shows an economy that's also not too hot. Inflation, as I mentioned, has come down significantly, and that really completes the picture of a Goldilocks economy. Growth is very resilient, and inflation is coming down. So you take this Goldilocks scenario, and then there was also definitely excitement over generative AI, and you have investors flocking into global equity markets with a lot of confidence. Now, on the next slide, so I discussed the Goldilocks scenario, but we don't want to be complacent. Ayaw natin na mag-invest lang sa markets na to without carefully analyzing them. It can create surprises if we aren't careful. So we need to be watchful over cracks that we see in the US economy. So the left chart shows the leading indicators in the US, which has actually turned negative. So this often means that there is an incoming slowdown in growth, or worse, baka may recession, and those are represented by the gray bars. Because these are leading indicators, this doesn't mean that GDP growth will automatically be negative or it's bad today, but it's just more of like a warning sign na baka medyo sumama na yung mga major economic data in the coming months or coming quarters. And on the right chart, you can see that there's also weakness in the labor markets in the US. And this is something that the US Fed is very watchful for. You can see the green line is underemployment, blue line is unemployment. But whether you look at, the green or the blue line, both of them are ticking upwards. And the US Fed doesn't want to see that because their economy is so reliant on consumer spending. And the good news again is that the US Fed has reacted strongly to the cracks in these economies. They cut interest rates by 50 basis points, which was more than what we expected. Their message was also very balanced but dovish. Dovish meaning it's very strong in terms of the messaging that they will support the economy. So this actually gave us enough confidence to revise our expectations on the US economy to actually remove a US recession from our forecast. And overall, this should be good news for global equity UITFs because as we showed earlier, if we get rate cuts and we're able to avoid a recession, then there's a good probability that global equities can continue to rally. Can it be as strong as the past 2 years? We have to wait and see. But definitely there are good opportunities. We like those quality companies. May slow down pa rin sa growth. So you still have to be selective in the companies that you choose. Look for those with quality. Yung mga matataas yung profits, matataas yung mga return on equities. Those are the ones that you want to invest in. And you also want to invest in value. Now, there's usually a comment, medyo mahal na yung markets na to. But really, a lot of the expensiveness is concentrated dun sa mga large caps. There's actually a lot of opportunities if the rally starts to broaden to those mid-cap and small-cap companies. Now, on the next slide, we'll move on to a different category of investments, which is our Asia equity UITFs. So on the next slide, you can see Asia equities have seen a more mixed performance over the past 2 years. Again, the left chart shows the performance in 2023. The right shows the performance in 2024 as of September 30. It's been more varied. The strong performance hasn't been felt across all Asia equity funds. In fact, in 2023, you saw a lot of Asia equity funds having flat returns or even negative returns. There's been one exception. India equity has been very strong. And that's really because its economy is standing out in terms of other economies in Asia. And this has actually made it a consistent outperformer in both periods. And the third is observation that we want to point out. It's been more volatile to invest in Asia equities. So you still see these very massive gains in Asia equities. Just recently, yung China equity fund namin, yung Dragon Growth, it's up like 20% in the past month. But then again, this comes with a lot of risk because the thing is, Asia economies are actually under more pressure compared to their developed market counterparts. So we'll show it in the next slide. Again, it's the same slide actually that we showed earlier, but this time we want you to focus on a different part of the chart. So the yellow line this time shows 2024 Asia GDP growth forecast. And from 4.5%, bumaba na to, naging 4%. So nagda-downgrade yung mga economists sa growth expectations sa Asia. And that's because a lot of the local economies are struggling with their battles inflation, especially on the consumer spending side. And then the gray line shows 2024 China GDP growth forecast. Hindi naman siya ganun kasama. If you look at it, it's been actually around 5%. But the challenge is that this is actually below what people want. They want China to return to pre-pandemic levels, yung mga growth na 6-7%. And it's a struggle to really get that economy growing to that level again. And on the right chart, we want to show you why. Yung China property market is really at the heart of China's problem. The green and pink lines show how much new floor area has been sold and has been started by these property companies. Both are down by 20% year on year. That's a very deep contraction. If you remember my earlier charts ko sa US, you didn't see these types of contractions. And this just shows that the contraction in these economies in Asia have been much deeper compared to those in developed markets like the US. Okay, next slide. There is a silver lining to all this. So it doesn't mean that there's no opportunities in Asia equities. Actually, there are. The left chart shows that policy easing is well underway in China. Si US, si Philippines, this year lang nag-start mag-ease. Si China did it 2 years ago already. So it's not something new to them. They've been trying to revive their economy for so long already. So just last week, in fact, they actually announced a stimulus. So hindi lang rate cuts, but they're also actually doing fiscal spending, mga targeted stimulus dun sa property sector to really revive their economy. Now, whether it's going to be successful or not, we have to wait and see, but they are trying to support and recover their economy through all of these stimulus, and that creates optimism in the market. And then the right chart shows that Asian countries also have a lot of room to cut rates further. So the green bar shows real policy rates or yung difference ng policy rate versus inflation. So if this is positive, it means that policy is a bit restrictive. Yung mga tao, they would rather maybe invest in a safe instrument that can already beat inflation. But the blue dots show where it is historically. So you can see there's a lot of room for that green bar to go down all the way to where the blue dots are. That means there's potential for rate cuts across Asia. So Asia equities in some cases might be an example where investors do not believe that the rate cuts were preemptive, and that will take time to reverse the slowdown in the economy. But as we showed earlier, these scenarios tend to have more mixed performance. And the good news is that the stimulus is well underway. Also, these markets, they tend to be very cheap at this point. So whereas I told you earlier, yung mga US markets, global markets, they're quite expensive already, especially in certain segments like your large cap companies. These ones are actually very cheap. And if you can select the countries or the companies where the growth is actually strong, nadadamay lang siya sa pessimism over the economy, then there's a very big opportunity also in these Asian equity funds. And finally, next slide, please. We just want to highlight yung mga income-paying and low volatility UITFs because equity is not for everybody. On the next slide, again, just to show you the performance of our income and low volatility funds, you can see that in 2023 and 2024, they have been very consistent. And that's because a lot of the returns from these funds are coming from yung mga coupons, yung mga dividends. A lot of them are invested in fixed income. May mga konti na naka-invest in REITs, naka-invest sa equities, but really a lot of their returns, a lot of their payouts if their income funds are coming from the income that they receive from the securities that they hold. And the key message here is that our income and low volatility funds can be a source for steady income and performance to balance yung volatility of equity funds. And that's actually what we want to highlight in the next slide. It can be a potentially bumpy ride for investors. We're already seeing it today. The left chart shows you that stock market volatility is picking up from the lows. The right chart shows the same picture in the bond market. Market name volatility, and that's because even though we're not seeing a recession anymore, at least in our view, there's still a slowdown in growth and people will start to become more jittery. Growth is still expected to slow down again, and central banks will need to adjust their plans as data comes in and the markets will react. So to protect yourself from volatility, yung income funds which tend to derive their value from yung mga dividends and coupons can be a source of resilience for your portfolio. So it's good to also mix or diversify into different asset classes. And then if you want something even more defensive, we also have money market funds, fixed income funds, and these are even more resilient and more defensive. Okay. Then on the next slide, now one concern that we usually get from these types of funds is bumababa na yung interest rates, baka bumaba na yung income payout, or bumaba yung potential returns niya. But what we want to highlight is that hindi naman agad-agad bababa yung interest rates. If you look at our forecast, yes, it's going to go down, but it's not going to go down back to near zero levels. If you remember what I said about the US, nanggaling siya from 0.25% all the way up to 5.5%. We're only forecasting it to return to 3% by end of 2025, not all the way back to 0.25%. There's still decent yield that you can get from these fixed income securities or these income paying funds or fixed income funds. And then on the next slide, just to show you how consistent the payouts have been for our income funds. So we have 5 income paying funds, 4 of them pay out monthly, and you can see they've been very consistent in terms of their payouts. ever since we shifted to monthly payouts in August 2023, there hasn't been a lot of movement in terms of yung month-on-month payouts that they give to investors. That's because these funds are still actively managed. So kahit bumababa yung interest rates, you have a fund manager who's constantly looking for new investments for you that will give you a very decent payout, even if interest rates start to go down. So I think that's my last slide already, but I'll be happy to take any questions that you have. I'll turn you back over to Monneth for the rest of the presentation.
Okay, thank you so much, Sir Paul, for explaining the context of rate cuts and also the impact on UITF. So I will reshare my screen. Hold on for a second. Okay, there. So with the given strategy presented by Sir Paul, I know the audience right now are wondering how to invest in Manulife through our FirstMetroSec account. So here I will actually share to you that you need one powerful account for all of your investment needs, and that is through First Metro Securities, your one-stop shop for all of your investment needs from stocks, real estate investment trust, mutual fund bonds, and as well as UITFs such as Manulife. And aside from that, from being a powerful investment account, you make sure you partner with the best. So we have been awarded as the best one-stop shop solutions for leading funds by the international business magazines, aside from being the best online broker and best online trading platform for 7 years in a row now. So for those who still don't have a FirstMetroSec account, here's how convenient and easy to open a FirstMetroSec account. You just need to go through our website via www.firstmetrosec.com.ph or download our FirstMetroSec Go application. And when you are asked where did you know about us, please indicate the seminar code Manulife. So you just need to prepare Philippine government issued ID, proof of residence, proof of bank account, and 1,000 pesos initial deposit, and also your tax identification number. So once you have an active FirstMetroSec account, you can now avail Manulife funds through our FundSmart. So you need to access your FirstMetroSec account via our My platform. So that is through website. Just indicate my.firstmetrosec.com.ph. And afterwards, once you are on the landing page, you click Funds tab on the upper right. There. So if this is the first time that you access the Funds tab, kindly answer the risk profile. This will provide you the recommended funds suitable for your risk. And then click FundSmart, and you may click also all providers and choose Manulife Investment Management and Trust Corporation. So it will show all the funds available under Manulife. And you may click the description tab. This will show the fund size and as well as the start date of the fund. So you can sort the biggest fund size or even the oldest UITF fund available in Manulife. As to the performance tab, this will allow you to sort the day change, year-to-date change, 1, 3, or 4 year, 1, 3, and 5 years performance of the funds. And with the fee structure tab, you can also see the management fee, the minimum investment, and the minimum additional investment under the fee structure tab. So if ever you are looking into certain fund, for example, Manulife in India Equity Feeder Fund, so just click that fund profile so that you will know more about the fund, the graph, the year-to-date change, even 3 to 5 years performance, and also the top holdings for Manulife India Equity Feeder Fund. So once you are decided, you just need to click subscribe and indicate the amount that you want to invest for as low as 1,000 pesos. And click subscribe, encode your password. So after that, you click portfolio and it will actually reflect on that red area. So normally it will take 1 to 2 or 3 days depending on the fund that you have chosen. So turned around time or the reflection of the fund on the portfolio will depend. So another benefit of investing pooled funds through FundSmart is you make the most of your money because you will be paying zero. So walang sales load na additional, no other commission, at walang transaction fee. So these costs are actually standard when you buy pooled funds direct from the source. But because you are doing it on your own through online, you get charged with nothing. You only end up paying fund management fee. So that's another big reason that you start investing in FirstMetroSec FundSmart. And you may also consider the strategy, peso cost averaging strategy, wherein you continuously invest regularly. So it may sound easy to execute investing regularly, but it is challenging to maintain the discipline consistently. So you save yourself time and effort in growing your portfolio by automatically investing in Manulife through our voluntary investment program. So the voluntary investment program encourages disciplined investing, provides automatic diversification, and makes investing hassle-free. So no need for you to subscribe manually. So actually, it will automatically invest once you enrolled in voluntary investment program. But to get started, you need to decide on three things. The first one is how much to invest for as low as 1,500 pesos. Second, how frequent is it, once or twice a month? And third, where to invest. So just ensure that your account is funded so that by the time it is already debiting date or subscribing date, you have sufficient fund, and subscription of your desired fund will be completed either 15th or 30th of the month. And feel free to connect with us on social media channels. Just search at FirstMetroSec. You may scan the QR code or screenshot of this slide. Our main website is www.firstmetrosec.com.ph. And for any account requests, updates, concerns, email customer service at firstmetrosec.com.ph. And I also want to invite you to our next webinar that will be on October 9. Registration link will be provided by our chat moderator, or you may also check our FirstMetroSec Facebook page. And lastly, for customized, gamified, award-winning market education programs exclusively designed for your company, organization, or school, just send us a formal invite at marketeducation@firstmetrosec.com.ph. And at this juncture, may I once again call our speaker to turn on his mic and camera as we accommodate any questions you may have. So for those who still have questions, simply write them on the designated Q&A section of the platform, and we will try to get through as many as we can. So those who won't make the cut because of time constraint will answer it offline. So I'll check if we have questions in the Q&A. Okay, so we have here one question, Sir Paul. Hi, Mr. Paul. With the expected volatility affecting the US economy, which in turn also affects Asian economies like ours, what is your recommended percentage mix for our investment in financial instruments in the coming months?
Okay. Yeah, first, I think the mix sa portfolio will still depend on the individual investor, depends sa risk profile mo. But I'll try to give you some ideas on how to build the portfolio. If you're just looking at equities, I think global equities will still be less volatile compared to Asia equities. Yung mga economies in developed markets like the US, again, we're expecting them to remain strong. They'll slow down a bit, but we don't expect them to enter a recession. We think that there's a lot of high quality companies, and there's still some value in US equities. There are sectors like healthcare, and we have a healthcare fund. These are sectors that are very defensive when even if there's like a recession, people will still continue to buy medicine. They'll still continue to have their medical procedures that will remain resilient. And there are opportunities like that in the US stock market. Our fund manager for American growth, our global equity funds, they recognize this, that there's more sectors that we can invest in when we're looking at global equity funds, and they can diversify better. Asia equities naman, you're correct actually, na if there's something that happens in the US, it slows down. Asia economies are very sensitive to the US. A lot of them are still linked to the trade with the US. So for Asia, I would say focus on those with strong domestic economies. And as we mentioned, India has been one of the strongest economies, notwithstanding what's been going on with the global economy. They have a very strong domestic economy. They're formalizing their economy. They're getting a lot of rising middle class. Their population demographics are so good. So that's one of the stronger economies, which we think even if there's a slowdown in the US, can still continue to grow at a very decent pace. And then obviously you have your mga ASEAN countries. You just have to be a bit more selective on which ones are less linked to US trade. And then obviously you can always balance it with our income paying funds and our money market funds. You don't have to go 100% in equities if you're not comfortable with the incoming volatility. You can put an allocation or invest a bit in those income paying and money market funds as well.
Thank you for that, Sir Paul. So again, the allocation will depend on the risk profile of the person or the investor as well. So we have one question here from the chat box. What are your insights on US dollar investment, UITFs, bonds, or equities?
Oh, sorry, can you repeat the question?
What are your insight on US dollar investment like UITFs, bonds, and equities?
Actually, well, for Manulife, we don't have a view on the currency, on the US dollar and Philippine peso exchange rate. But what we can tell you is even though there's a lot of concerns na baka um, mag-appreciate yung peso versus the dollar, and that can be negative for yung mga dollar investments natin. Actually, if you look at the interest rate differential, so yung difference ng interest rates in the US and the Philippines, it's not really moving a lot. You know, the US is cutting rates, but so is the Philippines. So the US cut by 50 basis points, BSP cut by 25 basis points earlier, but then after they said with the US cutting rates, we have more room to cut rates as well. So the differences in interest rates might actually be the same. And again, we're not expecting the US to go all the way back to zero interest rates. We're only forecasting them to go back to 3% by end of next year. So you have to manage your expectations also on the potential weakness in the US dollar.
Thank you for that, Sir Paul. Another question from anonymous attendee. How will the geopolitical tension in Israel and Arab states affect the global market for the next few months, especially in the context of US elections?
I think, well, first, the geopolitical risk has obviously had some impact on the commodities market, specifically yung oil prices. But I think if you look at a lot of the developed markets, they're not as reliant on oil markets in the Middle East anymore. They found other sources of energy. They found other sources of oil as well. So they've been more insulated in terms of the impact to their economies. Asian markets are a bit more sensitive to movements in oil prices, especially countries like the Philippines where we're net importers. So it could impact us a bit more. Now, in the context of elections, well, what Manulife always says is that whether it's a Republican president or a Democrat president, there's really not a lot of big differences in terms of how stock markets perform if you look at just the history of the S&P 500. And one thing we're highlighting for this election is that it's actually a very close split when you look at the Congress and when you look at the Senate in the US. So even if one president wins over the other, it's still very difficult to pass any major changes to laws in the US, to things like corporate income tax. Those will be very hard to pass because you will probably get a deadlock still in Congress and in Senate.
Okay, moving on to the next question. What sectors will benefit most with rate cuts? And will there be sectors which will be disadvantaged?
I think in terms of the sectors, our preferences right now, we look at it more like factors. We want quality companies. the rate cuts are coming, but they're because of a slowdown in the economy, the cracks that I was talking about. So we still want to invest in the companies that are very profitable, where they don't borrow a lot, they have strong balance sheets. Actually, a sector like that is the tech sector. Yung tech sector ngayon, it's not like what it was in the 90s na walang cash yung mga companies na to. They're actually one of two sectors that's in a net cash position. So they've become this very risky sector to actually a very high quality sector. And that's something that's being appreciated by the market these days. You talk about companies like Microsoft, like Amazon, like Apple, they have a huge hoard of cash and they can deploy it if they need to, if they see like opportunities in the market, they can make use of that cash. And then another sector again that we like is the healthcare sector. Again, the rate cuts are coming because of a slowdown in the economy. So you want those with a bit more value and a bit more defensiveness as well.
Okay, noted on the technology and healthcare sectors, Sir Paul. Now, moving on to the next question, again from anonymous attendee. You forecast that there will be no US recession anymore. Please relate to the inverted bond yield curve, which is already happening.
That inverted bond yield curve is actually one of the leading indicators that I was talking about. So it's part of the list of leading indicators that usually signals that there's going to be a slowdown or a recession in the economy. So it's taken into account when the Fed looks at this data and reacted already. So the US Fed has already made a strong first move by cutting interest rates by 50 basis points. That surprised a lot of people in the market. And their message was also very strong. They were saying they will support the economy if they continue to see these cracks start to widen or start to seep into other parts of the economy. And actually, it's really that support that the US Fed pledged, which made us believe. And they also walked the talk by doing 50 basis points. And that's really what caused Manulife as a firm to remove our forecast of a US recession as our base case scenario. Although I do have to point out that even though before we were forecasting a US recession, we were only forecasting a shallow recession because the US economy is still very resilient. US consumer spending is still very strong.
Okay, thank you for that, Sir Paul. We have this one question intended for me now specifically. So I have a FirstMetroSec account and I would like to invest in USD mutual fund. Do I need a dollar bank account to fund the USD mutual funds or UITF? Well, you don't need USD nominated bank account. For as long as you already have a FirstMetroSec peso account, you may open a FirstMetroSec US dollar account and then nominate your peso denominated bank account. Well, the thing is, by the time that you will withdraw money, it will automatically be converted to peso at the prevailing exchange rate. Okay, so now let's have another question here. What is the expected impact on REIT dividends and capital appreciation due to lower interest rates? Is it good or bad?
I guess on the REIT dividends, one thing we want to highlight with REITs is that they've been very defensive. So even though there's been a lot of volatility in the REITs markets over the past 2 years, the dividends and the rental income that they receive from the properties that they hold has been very consistent, except for a few sectors like, let's say, office REITs. That's been a bit of a struggle. But if you look at a more diversified portfolio of REIT securities, we've been collecting the rental income. Now, on the capital appreciation side, again, the dividend yields of REITs has been very consistent. When I look at it, whether it's our Asia REIT strategy or our global REIT strategy, dividend yields has been 4.5% to 5% levels for the past 2 years. That was a problem when interest rates in the US went up from 0.25% to 5.5%, because suddenly investors were thinking, I'm not going to gamble on REITs, which is yielding 4.5% to 5%. I'll just put it in a safe instrument that's yielding 5.5%. And that's why we saw a lot of sell downs as well on the REIT securities. But now that you're going to see rate cuts, that 4.5% to 5% dividend yield will look attractive again, especially if we get to 3% interest rates by next year.
Thank you for that, Sir Paul. Let's have another question here. So among the top performing MTC funds or Manulife funds year to date, which are already considered, are these already considered expensive at the current level?
Yeah, I
And
think yeah, I can answer that. So I'll focus on a few funds. I think on the global equity funds, the ones where we get this question the most is our global technology and our American growth funds. What we want to highlight again is these are actively managed funds. So if you're investing passively in, let's say, the tech sector or US markets, they'll just invest it in the companies which have the largest market capitalization, the largest companies, which happens to be the most expensive part of these markets. I can tell you that the funds that Manulife holds are actively managed. So for example, in our global technology fund, one of the things that they've been doing is they've been selling a lot of the large cap names which ran up already because of artificial intelligence. These were yung mga semiconductor companies like Nvidia. They were starting to take profits already and they've rotated now more towards yung mga application software, which hasn't fully valued in the potential benefits of artificial intelligence. So there's been that shift already in anticipation of a broadening of the rally in the tech sector. And similarly, dun sa American Growth Fund namin, we're seeing them take profits in the mega cap companies as well and trying to look for a balance between growth and value in the portfolio. So that's really the benefit of active management. Even though the whole market is expensive, there's still definitely opportunities where there are so many companies in this technology sector and in the US market.
see, so the answer really lies on the actively managed fund. So it can go beyond the 27% year-to-date performance already. Now we have another question from anonymous attendee. What is your forecast for BSP rate by end of 2025?
Well, we don't have a specific forecast, unfortunately, for the local markets. Our global team just really focuses on the US markets, which really affects most markets. But again, what we're mentioning is there is scope for the BSP to cut interest rates, especially with the US Fed also cutting interest rates because they don't have to worry about the currency as much. They can match the US Fed step by step in terms of interest rate cuts. So that will help keep your currency stable, which I think they would appreciate. At the same time, you're also potentially seeing a lot of room for the BSP to cut rates. I had a slide earlier where the real policy rates in the Philippines is significantly higher compared to where it was historically since I think like 2009, so 15-year average. So there's a lot of room for the BSP to cut rates as well.
Thank you for that, Sir Paul. We have another question here specific for the FirstMetroSec platform. So the returns indicated on the FMS platform year to date, year on year, are net management fees and taxes already? Yes. That's already net of all the charges. And I'll take one last question. Could there be a possibility that the rate cuts be delayed, and what factors will influence this decision?
Right now, it's not in our base case scenario. We think the rate cuts medyo tuloy-tuloy na siya. I think we had a slide showing you that it's going to be consistently going down until end of 2025. But if you want to be watchful of what could derail the rate cuts from happening, definitely a return of inflation. They don't want to see suddenly demand and speculation coming into the market. You don't want the US Fed or the BSP or central banks don't want to see that return because it was really a challenge for a lot of economies to deal with inflation. But right now, that's not our base case scenario. We think they'll manage a soft landing, which means that they'll be able to bring down interest rates without really making the economy run too hot.
Thank you for that, Sir Paul. So that sums up our Q&A portion. Thank you so much for all of your questions. And of course, thank you very much for our guest speaker, Sir Paul, for gamely answering the questions. And to our attendees, we also value your feedback. You can share your thoughts and experiences with us by scanning the QR code and answer our feedback form. So link will also be provided by our chat moderator. Your input is essential in helping us improve our services and better meet your needs. So we appreciate your contribution and we look forward to implementing positive changes based on your valuable feedback. Again, thank you so much, Sir Paul, and we look forward to our next collaboration as we continue to serve the Filipino investors. Perhaps you have some parting words before we formally close this webinar.
I guess the main message for us in Manulife is to really take advantage of the global investment opportunities that are now available to you. You didn't have this available 4 years ago when you had the rate cut cycle. Now you have it available. So explore this, diversify your investments, and don't just limit yourselves to what was available before.
Okay, so there you have it, guys. Once again, on behalf of First Metro Securities Brokerage Corporation, I would like to express my deepest gratitude to Sir Paul of Manulife Investment Management and Trust Corporation for gracing us with his time and presence. It is truly an evening well spent. Thank you also to everyone who attended tonight. We sincerely hope you have learned a lot and that these insights and lessons will make your investment journey not just more profitable, but also more enjoyable. So please don't forget to provide feedback for today's webinar. We hope to see you again in our future learning events because over here at First Metro Securities, we put your future first. Have a great evening, everyone. Thank you so much. Thank you, Sir Paul.
Thank
Great
you,
talk.
everyone.